For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Palantir has once again claimed its place among the top performing stocks, delivering remarkable results across both the Standard & Poor's 500 and the Nasdaq 100 indices. The data analytics and artificial intelligence powerhouse has continued its incredible run into 2025, building on its stellar performance from the previous year. Fast forward to June 10th of this year, and the stock has already gained a staggering 74%, an eye-catching performance that has caught the attention of institutional investors and retail traders alike. The surge in Palantir's stock price is largely attributed to its ever-growing influence in the artificial intelligence sector, where it delivers high-end data integration and decision-making tools to government and commercial clients. The company has positioned itself as a dominant player in the digital transformation movement, appealing to both traditional institutions and tech-forward portfolios. While the bullish sentiment surrounding Palantir remains evident, a deeper look at valuation metrics and institutional behavior reveals that all may not be as optimistic as it appears on the surface. One of the most prominent metrics raising eyebrows among market analysts is Palantir's price-to-sales multiple, which currently sits at 105. This figure is notably higher than those of other leading software firms within the same growth category. What this tells us is that investors are paying a significant premium for every dollar of revenue that Palantir generates, a level of enthusiasm that mirrors some of the most speculative phases of the market, including the height of the dot-com era. This expanding valuation suggests that many investors are caught in the excitement, chasing momentum rather than carefully assessing the company's fundamentals. This exuberance raises an important question: who exactly is fueling this relentless demand for Palantir stock? A look at the history of major players reveals some interesting developments. Cathie Wood was one of Palantir's earliest champions. Shortly after Palantir entered the public market in late 2020, Wood frequently appeared in financial media to voice her bullish stance. She praised the company's potential to reshape the software landscape, emphasizing how Palantir's platforms could eventually supplant older, less agile providers. However, her conviction was not unwavering. In 2022, Wood exited her entire stake in Palantir, surprising many who had followed her investment thesis. But in a twist of events, she began accumulating shares once more during 2023. Given the current stock price, it is clear that ARK Invest's position is sitting on substantial gains. Despite this, Wood has started to scale back her position again in 2025, signaling a shift in sentiment and possibly a strategic move to lock in profits. Billionaire investor Stanley Druckenmiller, who runs the Duquesne family office, has also made headlines for his decisions regarding Palantir. According to the fund's most recent public filing for the first quarter, Druckenmiller has completely exited his Palantir position. Like Wood, his approach has been one of tactical entries and exits, indicating a careful weighing of risk and reward rather than a buy and hold philosophy. His exit adds another layer to the growing list of influential investors opting to reduce their exposure. While neither Wood's nor Druckenmiller's actions necessarily suggest a bearish stance on Palantir's long-term potential, they do reinforce the idea that now may be an opportune time to harvest some gains. The stock's current valuation is not only extremely high, but also reminiscent of past market periods when irrational exuberance took hold. This type of environment can often lead to corrections, especially when investor expectations outpace the underlying growth trajectory of the company. Institutional activity provides further insight into what may lie ahead. Toward the end of 2024, there was a noticeable increase in institutional buying. However, selling activity also began to tick up at the same time. Both buying and selling trends continued rising until the beginning of 2025, when they converged. This convergence indicates that although large investors are still net buyers of Palantir shares, the margin between purchases and sales has narrowed significantly. Since the start of the year, the pace of both buying and selling has started to level off. The flattening of these trends suggests that institutions may be adopting a more cautious stance. Rather than aggressively buying more shares, many are holding steady, possibly evaluating whether the recent run-up in price can be sustained. If this cautious posture turns into broad-based selling, it could trigger a steep decline in Palantir's stock price. The narrowing gap between institutional buyers and sellers is a warning sign that the current momentum could shift in the other direction. From a broader market perspective, such behavior often signals the start of a valuation reset. When momentum stocks become overbought and institutional enthusiasm begins to wane, a sell-off can bring the stock price closer to a more reasonable level. This is not necessarily a negative development. It can serve as a healthy recalibration that sets the stage for more sustainable long-term growth. Palantir, with its strong fundamentals and wide moat in data analytics, is well positioned to thrive even after such a correction. However, for investors caught in the short-term excitement, a sharp decline may feel like a major setback. So, what does this mean for your Palantir position? Should you sell all your shares and walk away? Not necessarily. For long-term investors who believe in the company's mission and disruptive potential, staying invested may still be the right move. Palantir has consistently demonstrated its ability to innovate and expand its customer base. It continues to grow both its government and commercial segments, cementing itself as a vital partner in modern data solutions. That being said, taking some profits off the table could be a wise and strategic decision. Locking in gains after such a massive rally helps reduce risk and provides liquidity that could be deployed into other undervalued opportunities. This approach allows you to continue participating in Palantir's future upside while also protecting your capital from near-term volatility. In the end, Palantir has continued its streak as one of the standout performers. Building on its dominant showing from the previous year, the company has benefited from strong investor enthusiasm tied to its role in artificial intelligence and data analytics. However, concerns are beginning to surface about a possible sharp downturn during the second half of the year. One major red flag is Palantir's soaring price-to-sales ratio, which currently stands at 105, well above that of its software peers, raising doubts about the sustainability of its current valuation. Additionally, notable investors such as ARK Invest's Cathie Wood and Duquesne Family Office's Stanley Druckenmiller have either reduced or completely exited their positions, reflecting a broader trend of caution among institutional players. While institutional buying still slightly exceeds selling, the narrowing gap and recent flattening of activity indicate waning momentum. Given these factors, while long-term investors may still believe in Palantir's disruptive potential, locking in some gains now could be a smart move ahead of a possible correction. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.